Hello, everybody. I just wanted to share with you the interview I did this morning with Nadine on Ausbiz because I talked about two little small caps that I quite like. One, Energy One, you've probably heard me talk about before, and I hold shares in that, of course. And the other is Kinatico, one I haven't really talked about much, that I also have bought shares in, and it's in a much earlier stage, much earlier company, as you'll see during my chat. But I nonetheless thought that you guys who subscribe to the YouTube channel might really like it. So here I am posting it. Let me know if you want me to post these videos when I do them. And of course, if you want to catch the latest videos whenever I post them, please make sure that you click the little bell to say that you'll get alerted when you subscribe. Because otherwise only around 10% of the people even see the videos. So thanks a lot. And yeah, see you again soon.
One of my favorite areas of the market, the small cap space, get into where my next guest sees potential. Claude Walker from A Rich Life joins me now. Welcome, Claude. Nice to see you again. So where is this conversation starting? Because you've uncovered quite a few little gems for us over the years.
G'day, Nadine, and thanks for having me back on. Yeah, I just wanted to start a small cap chat by talking about one that I used to bang on about quite a bit here on Ausbiz. Particularly now because so much has changed with it. And the stock I'm talking about is Energy One, which I still own shares in. In fact, it's actually the first company in many years to become a bigger position in my portfolio than Pro Medicus has been. So it's actually now my biggest position. In particular, I talked about this a lot in 2023, in February, May, September, October, because at that stage, Energy One had some bad luck with cybersecurity incident, in fact, I think hacked by Russian criminals, and essentially the share price was down in large part because of that. You did have opportunistic takeover bid provide some support at that point, but I was actually quite against that and quite worried that takeover could go through. But luckily, a bunch of shareholders bound together to stop that takeover happening, and now we're reaping the rewards. You can see that quite recently, finally, the mainstream press, everybody has started to talk about Energy One. It's $17.99 as we speak today. And essentially, I just wanted to give viewers a little update on that story. Essentially, what happened is finally they got some clear air and had some good results that weren't impacted by just various bad luck things that I talked about before. And that has just seen the profit numbers improve massively. And then everyone has started to take note. Now, I did want to call out congratulations to Wilson Asset Management. They are the first mainstream fund, the first big guy fund to really spot what was happening, and they bought up after the H1 results, and they bought a big chunk of the company. And then, quite ironically, now after the full year results, after the average cohort of funds have started to realize about this company, the slow coaches, Wilson Asset Management has actually sold at a quick profit a bunch of their shares to those Johnny-come-lately ones. And so that's easy money for them. Well done. But also, I think ultimately they're probably making a mistake because they are selling quite early in the piece. This has only just become on the radar of all of the fundies now are snapping at it. And we've seen the chairman, who's the largest shareholder, sell down at one point. We are going to see a CEO transitioning coming up. So there is uncertainty on the horizon. And for me now, it's actually a hold. It's out of that buy zone for myself. And indeed, I did sell 5%, issued 5% sell for my subscribers. So we've taken a tiny bit of profits. And look, still very high conviction on the long-term story here. It's still early because this is not even like in the it's so far from being in all the indices. The people that I'd really say are the late guys are generally the passive index funds. So we're not in the ASX 200 yet. There's still a long way to go with Energy One. So even though I do think it could be up and down from here, and we have had a big, strong run lately, taking a tiny bit of profits, I still like it for the long term.
So a long-term hold then for EOL. All right, gotcha. So
absolutely.
What's another idea? Maybe one that is not being talked about as much, because that's the thing, isn't it? You want to get in if you can before everybody jumps on the bandwagon.
Yeah, so it's hardly a foolproof plan because sometimes you think some under the radar stock is doing good stuff and you think that it'll one day become, the next Energy One or the next kind of Pro Medicus. And it's never going to be that good really because that's just cherry picking the best ones. But nonetheless, the process does work because as a company gets bigger, as it improves its financial results, more people start taking notice. You have more people taking notice, you have more potential buyers. It tends to push the price up. So the one that I wanted to highlight today is a stock called, which I also own, by the way, Kinatico. I think it's relatively to Energy One anyway, definitely still way under the radar. Like, we haven't even seen any sort of mainstream funds get super interested in it, and it's $150 million market cap. So it's much smaller. It's a software company. Most people wouldn't have heard of it yet. It doesn't have such cool B2B software as Energy One, which does wholesale trading. What they do have, though, is sort of like compliance and regulatory software. So basically helping with the workflows that might be getting a police check for a new employee. It might be checking that there might be a compliance task, like you need employees to sign a declaration every quarter or something. So they have like tools where you can automate that. There could be various things. And in fact, increasingly different industries do have some sort of qualification or regulatory thing, whether it's working at heights or whether it's working with children or whatever it may be. People do have to have checks or have a declaration and stuff on a regular basis. So their software is designed to help solve that problem, sort of sit on top of whatever software has all the information about the employees and be able to direct tasks to the ones or workflows to the ones that need to do something. So they also have a bit of a problem because a lot of their revenue, about half, is actually just from on-selling, say, police checks. Now, what made me want to buy shares in Kinatico is that the revenue from their sort of software solution that I described to you just overtook their revenue from basically, I guess, on-selling the services of a police check. So to me, I really think that as that sort of software revenue becomes a bigger part of the overall revenue picture for Kinatico, it will be an improving quality business. And that is, even though it is a high share price right now, even though I'm not saying it's cheap, it's the improving quality of the business that could actually mean that it does one day start getting on the radar and does start getting to the big lead. The risk that I want to highlight is this company is quite promotional. They do a pretty solid job trying to tell everyone how strong they are. So that means the share price is already pretty high. And personally, now that I'm a shareholder, I'd prefer if they just focused on getting the results as good as possible. And also they give fantastic webinars for their full year results and stuff like that, which are recorded. And I think that's enough. They don't need to be doing too much publicity beyond that. I think the results will speak for themselves if they can keep growing that profit, which is quite small at the moment.
Yeah, remind me, because we've actually spoken with the CEO, Michael Ivanchenko, so that's online if you wanted to have a look. But they're overseas as well, aren't they?
I think it's principally Australia.
Okay.
Is their focus, yeah. So, and the big transition that they've been doing, so the theory that the CEO has said on Ausbiz and in many other forums is basically that they've been investing in their software that they call Compliance X or whatever, but I don't even see that brand out there that much. The main point that is different about this software is it's a customer self-serve model. So it's designed to make their customer acquisition costs lower by making the onboarding a lot easier. And this is a totally reasonable approach. Like, that is essentially a strategy that is a product-led strategy. They basically see that one of the difficulties of making money in a software business is the cost of customer acquisition. How do you onboard someone? How long does it take? And that is accurate. Like, it's a real area to target. So that's what they've been targeting. They've recently did a big publicity push because they've sort of launched this solution. And FY 2025 results, they said, yeah, they've actually started to have people sign up for the website as they intend. I think they've got a huge long way to go, and it's hard, it's hard to guarantee success. And I wish that they'd just be more conservative when they talk about it, because I feel like the risk is that they put the expectations really high, and then even if they do solid work, it disappoints the market and starts harming that trust. So my one concern I have is I always generally prefer management teams who are very conservative in what they say, and they really have the art of understatement down pat, because then it creates this dynamic where every time they put out the results, people are like, oh wow, it's even better than I expected, and it creates much more trust of the management. And then that trust results in a higher multiple. So yeah, love to see some more conservative, and they are targeting quite strong growth and whilst remaining profitable. But hey, if they hit their targets, that'll be great. And quite frankly, even if they fall a tiny bit short, they're still a good growing company in my opinion. But just if they're early stage, what can I say? It's as with Energy 1, 2, 3 years ago, we could have it down before we have it up. You never know.
Yeah, so you would be holding this one. I think you alluded to the fact that the share price is already run, so you wouldn't be putting fresh money in necessarily.
Yeah, no, actually, I do want to clarify that because this is so like, I'm talking 150 million here. This is still early enough for me to buy. I own it. I've bought it around current prices, and I could definitely see myself buying more around current prices. Like I'd say base case, I probably will. I'm just saying that if you're going to buy this sort of truly under the radar stock, you should totally be prepared for sentiment to impact the share price. So sentiment's riding a bit high in small caps right now. It's going up. Now that could keep going up, or sentiment could turn, and a little one like this, with so much depending on how people are feeling about how it'll be in the future, it could really come down.
Thanks for listening, everyone. The AFSL number is 276544, and my AR number, authorized representative number, is 1297632. If you like this, please give us a like or a subscribe or a comment, and put the little alert bell so that you get told when we release a video. Thanks a lot. Bye.